Alright, welcome to another video on how to secure yourself financially. So I'm just going to jump straight forward to the cash flow, specifically to the operating activities, just to make a quick recap of how this is done. So look at the net income from the income statement, analyze it, and conciliate with the total amount of cash that was used from operating activities. Operating activities, that the most common of there, you have operating assets and liabilities, where on the operating assets you have accounts receivables, inventory, prepay expense such as premium insurance like health for medical coverage, home vehicle, disabilities that prevent you from working, liabilities like lawsuits, life in the event of the policyholder's death, as well as the long-term care like home health care or nurse health care, and marketing, rent, office supplies, as well as software license and maintaining contracts are another prepay expense. So expense that a company has to incur for good and service that has been that the company pay but hasn't received yet, okay, or it will receive in the short, mid, or long term. So investment in affiliates is another operating assets like joint ventures, where it's a partnership between two or more companies, where each part shares a common, where each part. So a joint venture, okay, the TLDR is a partnership between two or more companies to undertake a specific business activity, where each part receives a share of the common venture, such as Crocs and Post Malone. Equity investments, which is once a company purchases significant amount of stakes on the another company stocks to influence and raise its voice, potentially to influencing the another company's management decision, such as equity investment, for example, like Warren Buffett, led by Warren Buffett, Berkshire Hathaway, where now this is a holding company that invests in a variety of sectors like energy, real estate, retail. SoftBank, which is a Japanese conglomerate that invests primarily in technology companies like Uber, WeWork, as well as Alphabet, which is a parent company from Google, or is Google's parent company that invests primarily in technology companies such as Calico, this longevity company. Texas Pacific Group, which is a private equity that invests primarily in technology companies or in other sectors like healthcare and retail. Limited partnership, where now a company or an investors purchase stocks on the limited liability LP in returns of some of the partnership assets or operations, as well as associate. where this associate is when investors or a company have 20 to 50% of the shares of another company. So with this example of this long-term or this investment in affiliate, which after all, the whole purpose of this is to invest in another company with the sole purpose of earn a return from that or gain some competitive advantage. Intangible assets like patents, which are exclusive right to provide exclusive right to inventors so they can manufacture, distribute, and sell their inventions over time. So the most, or at least I'm just going to mention a couple patents that change the word according to popular mechanics. So you have is the maglev, this electromagnetic inductive systems for stabilization and suspension of ground vehicle, issued in 1969. GPS, this navigation system using satellites with passive ranging techniques, issued in 1964. The iPhone, or as their patent name called, electronic device, issued in 2007. CRISP, this gene editing tool, issued in 2014. Trademarks, which are now exclusive use of the image, words, designs that uniquely identify this company from the competition. So, for example, the famous quote from Michael Buffer, the famous quote of Michael Buffer, like "Let's get ready to rumble." Okay, copyrights, which are exclusive rights to creator of original works, so they can manufacture and distribute and sell their invention over a period of time. So, for example, you have McDonald's, Netflix, Spotify, Twitter. Trade secrets, confidential data that the companies use to gain some competitive advantage, whether it's formula, process, or customer lists. Goodwill, which is the brand recognitions, reputations, and customer loyalty. Okay, and also customer relationship. Money market, particularly cash and cash equivalents, are another operating assets, where here you have things like money market funds, okay, which are funds that invest primarily in very short-term debt financial instruments such as bank acceptance, certificate of deposits, commercial paper, and repo repurchase agreements. So when I look at the now most common operating liabilities, like accounts payable, so money that a company owes to the suppliers and vendors, typically in a short term, some like 30 to 60 days, right? Deferred revenue, which are money that a company has collected, and obligations to provide good and service in the future, such as subscription service or the gift cards, right? Accrue expense, which are expense that a company incur for good and service that has been received but not yet paid for, such as rent, taxes, utility bill, salaries. I also look at income taxes or income taxes payable, so money that a company owns to the employees. uh, uh, correct. So money that a company owns to the government, this income tax payable. Uh, so you have things like corporate taxes. In the U.S. is something around 21%. Withholding taxes, which is uh, the employer deduct from the gross employees' salaries a portion and pay directly to the government, and this is to promote is the pay as you earn tax systems, or and also not or and also to fight tax evasion. If you're not in this kind of relationship, you should also pay your taxes as a contractor or investor. So you have to fill another form for that. Okay, that's good. Then also I look at mhm, sell taxes, which is another part of the tax, income taxes payable. So this tax, whether it's from the county or the city, VAT, which is a tax imposed the at every stage of the production of good and service along the supply chain, where the customer ultimately pay the full VAT from that. So the business along the supply chains remit that portion to the tax, as well as excise tax, which are tax imposed on certain goods like gasoline, tobacco, alcohol, guns, and GST, which is the good and service tax, which is imposed on the VAT, this value add tax, in places like Canada, India, or Australia. Another common operating liabilities, short-term borrowings. This is for a company that wants to meet their financial needs or working capital needs. So working capital is just a measure or a metric to see the financial health of a company, where this measure is the current assets minus the current liabilities. This to see if a company has some liquidity in the short term, as well as to see if the short term financial health. All right. And uh, so you have here is like banks, line of credit, corporate debt, okay, trade credits, which is now an agreement that you reach with your suppliers, so they can provide you the good and service for a in return of a uh, some notes payable. You agree with that, right? Or based on previous agreements, to pay those assets or to pay those good and service that they provide you in the short term, meaning a year or less. Outstanding invoice, when you want to raise funds from a lender, so the lender look at the value of your invoice and may borrow a certain amount of money based on the value of this invoice, as well as the outstanding invoice, especially if you have payroll advance, especially if a company have employees where, well, they give is an advance to the employers, and it will be deducted in the next payday. So with those short-term borrowings, I also look at something called the notes payable, which these are agreement between the borrower and the lender that the borrower outlines the TOS, the terms and conditions of that loan. Meaning, so for example, in contrast with the short-term borrowing, this is not imposed by time. So here you have is bank loans, okay? So when the bank is, so anytime a bank borrow money, or anytime a bank lends money to a company, it generates this note payable outlining things like the principal, the original amount borrowed, the principal, the interest, repayment schedule, as well as other things, right? So with that, okay, with that, business is is another notes payable, especially for a company that wants to raise funds from financial institutions like private equity or venture capitalists, or it create this notes payable. Bonds, so governments and corporations may issue bonds where they create these notes payable. So outline is, well, the principal plus the interest, as well as the repayment schedule based on that interest. And trades payable, which is now an agreement that a company reached to the suppliers and vendors. What they're going to outline is the repayment schedule of those good and service. So you get the idea here of this notes payable, that even it generate, okay, it generate this document, okay, between the borrower and the lender. That outline is this different, that outline is the TOS of a loan, okay? So from banks, from financial institutions or business, or from governments or companies that they issue bonds, from your suppliers and vendors like trade payable, as well as the thing with this notes payable is that I'm not quite familiar with that. That's what happened. And since I'm not quite familiar with, so how are you gonna know? So how are you gonna know that? So common investment activities. Operating activities here, that's right. So things like this, so notes payable. Even though that I put here some notes payable examples, so banks loan, Okay, business loans, bonds. Bonds are debt security issued by corporations or governments to raise capital. Exactly. So to raise capital, and it represents a promise to repay the principal amount along with periodic interest payment. The terms and conditions of the bonds are laid out in a bond agreement which serve as a notes payable. So promissory notes. These promissory notes are individual or business that may issue promissory notes directly to lenders. So when borrowing money, and these notes outline the terms of the loan. So promissory notes, but this is now directly issued to lenders. So individuals or business, including the repayment schedule and interest rate, making them notes payable. Trade payable. So in certain case, company may negotiate, but this is in certain case. In certain case, company may negotiate extended payment terms with their suppliers. In such instance, they may issue promissory notes stating the agreement upon terms, effectively creating a notes payable. Installment loans, when individual or business borrow money for purchasing assets like vehicle or equipment, they may enter into installment loan agreements. These agreements specify the repayment terms, including the amount of each installment and the interest rate, making them notes payable. So with this, specifically, that's the reason why I'm doing this video, is because I just want to look is so banks loans, it create banks notes payable. I just want to look at example of this. Okay, notes payable. Establish the note here. Accounts payable and notes payable. The notes payable. Okay, accounts payable and notes payable. So these are obligations that a company has in which the borrower issue a promissory note. Okay, yeah, in which the borrower issue a promissory note to the lender outlining is the TOS of that loan, the terms of service, the terms of condition, TOC, okay, the terms of TNC, the terms and conditions of that loan. The borrower agreed to repay borrowed amount along with any interest within a specified time frame. And here are some examples of notes payable. So you have bank loans, business loan. So bank loan is something, well, so anytime a company asks a loan from a bank, it generates this notes payable. Outline is the, well, here they don't show that, bank notes. Promissory notes, exactly, promissory notes, bank notes. Legal tender along with coins, they make up the bare form of all modern money. So these are bank notes. Polymer banknotes. Plastic-like banknotes, which Canada and many other nations worldwide use, are easy to clean and harder to counterfeit. The pros of introducing polymer banknotes also include their enhanced security features, reduced replacement costs, as polymer lasts 2.5 times longer than paper, waterproofing, dirt resistant, and overall lower negative environment impact. Include a high upfront manufacturing cost, counting difficult, given that the material is sleeper than paper, challenge in folding the new materials, and questionable compatibility with existing vending machines and auto payment systems. Okay, but they add this polymer banknotes. But in any case, bank loans is different from bank notes, because at the end of the day, these are notes payable, and bank notes is a negotiable promissory note. Very, very interesting. So bank notes in a debt instrument that contains a written promise by one party, the note's issuer or maker, to pay another party. The note pay a definite sum of money either on demand or at a specified future date. A promissory note is a written and signed promise to repay a sum of money in exchange for a loan or other financing. A promissory note typically contains all the terms involved, such as the principal, debt amount, interest rates, maturity, payment schedule, the date and place of issuance. But in any case, so this is promissory notes. This promissory notes can lie between an IOU informality and a loans contract rigidity. Okay, so when you talk about this promissory note, it sits between an informal IOU and a loan contract. Okay, an IOU merely acknowledges a debt and the amount one party owes another. A promissory note includes a promise to pay on demand at a specified future date, and steps required for repayment, like the repayment schedule. Promissory notes, or a pagaré in Spanish. Okay, so with this example, it represents something between the IOU informality and a contract and a loans contract. Okay, so this notes payable is an agreement between the borrower and the lender to stay in the terms and conditions of that loan. So you have bank loans, business loans, bonds, promissory notes, trade payable, and installment loans, as well as things like the warranty obligations, which is another part of the most common operating liabilities. Okay, warranty obligations, but okay. Oh, right. Okay. Mm-hmm. 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 But is this so? A notes payable is a promissory note between the borrower and the lender, stating the terms and conditions of that loan. So it sits between an informality of the IOU and a contract loans. So you have his bank loans. So when a company borrows money from the banks, it generates these promissory notes. Outlying is the principal, the interest, the repayment schedule. Business loans, which is company that now company that may borrow funds from other financial institution or other from business or from other business and other financial institutions such as private equity or venture capitalists. Bonds, so companies can issue bonds or purchase bonds from or purchase bonds from other from the governments and the companies. So they represent is a promise to repay the principal amount along with periodic interest payments. And then you have promissory notes, which are individuals and business that issue promissory notes directly to lenders when borrowing money. So outline is the repayment schedule, interest, and other conditions, trades payable, and installment loans. Okay. Okay. So with that, that'll be all for this video. Take care. Bye bye.